Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Fed meeting, jobless claims, and purchase applications. First, I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah.
Wonderful. You just got off stage at Meridian Link, did an amazing job giving a talk there. Very excited. And of course, you're gearing up for your big keynote at The Gathering, which is in June in Colorado Springs at the Broadmoor. Super excited, you guys. We are getting close to being full at that event. So if you want to go, please sign up. We're in the last weeks. Super excited about Logan's session, as well as some other blockbuster speakers and topics. So you don't want to miss that. So Logan, we have a blockbuster topic, and that is what the Fed did. We're recording this on Thursday. Let's talk about what happened on Wednesday.
Yeah, I think the funniest thing that we all got from the Fed meeting was Jerome Powell basically admitted that they were a little bit late in cutting rates in 2024. I don't know if he meant to say that, but I think the difficulty for the Fed right now is that they really don't want to cut rates any more than they're priced in. So even if there was no trade war or tariffs, they would have just hung out here, get the 2 rate cuts in, slowly find a neutral and just go with it. But I think what I saw from them is, Powell tried to walk around it, but really it came down to, well, our dual mandate is maximum employment, and if we see that the labor data is breaking, we'll act on that. I know other people had a different take about that meeting, but to me, it was just, I need to see this happen, and then we could make it part of the, Fed plan. So it's still labor over inflation, but reaffirming that they really need to see weakness in the jobs data to make that aggressive step. And again, we're talking on a Thursday morning, possible deal with the UK. Are there any more trade deals coming? I think they would be much more apt to maybe cut more if they knew that trade deals were going to fix some of these issues on shortages or anything on that, if the labor market's breaking. But I just got from they're prepping people for rate cuts, but we need to see jobless claims break or the unemployment rate really start to excel and some job losses.
Do you think it's ironic that he was like, yeah, we were too late on this. I don't think he said slow. He didn't say, hey, we're old and slow like you've called them, but he came close as saying, we're a little, we might have been a little late or something. And at the same time as being super cautious right now. Do you think that's the right thing to do?
The whole labor over inflation premise was that they were going to keep policy as restrictive as possible until they saw the labor market start to break. So in that case, the Fed funds rate was elevated versus the growth rate of inflation in 2024. So once they saw that the jobs data was getting softer on them, they believed that was too restrictive. So when they talk about they were a little bit late, they kept that policy above where they would feel comfortable if the jobs data is slowing down. And that's kind of the whole labor over inflation. They really need to see weakness. I think they're torn about what to do in a situation to where if there is shortages and price increases, do they facilitate that by stimulating the economy and then making that persistent? Or does the labor market getting weaker detract from that?
We know they're feeling incredible pressure, right? But at the same time, Jerome Powell has made it clear that he can stand up under that pressure. He said, I'm not going anywhere. I'm going to do this when I think it's right. So there's incredible pressure. Like as soon as, it came out that, what they were doing, which we all knew they weren't going to lower rates. You had some posts by President Trump. So, but it feels like we're just stuck until we see that. right now, maybe you can give us a sense of like where we are right now as far as that labor data and where we need to be for them to cut rates.
Today, jobless claims came out. The jobless claims data went lower again after the big spike. We talked about that big spike being just two states related. So I think if they saw a more persistent rise in jobless claims data, they would talk a little bit more dovish. But they're going to really hold on to that jobless claims data probably more than the unemployment rate. Because if they can get some demand destruction and have the inflation data not be as strong, they would probably welcome that.
So you've said before that you're looking for jobless claims to have on a 4-week moving average 323,000, right? That would maybe that's the level you're looking for. Where are we at right now compared to that level?
We're not even above 250,000 there, so we're still far from that. But again, what happened in the first 4 months of the year is going to be different if this if the trade war continues without deals. Of course, we'll see details of the UK deal, or most likely maybe India is going to come. Anything that will help get things transported and less shortages will probably be welcomed by the Federal Reserve. And if in that light, if you start to see weakness in the data with more deals being done, I think they would be more than happy to be dovish again in that context. But if you're waiting until you get to jobless claims by 323,000, then you've lost the cycle. And then I think they don't want to be all, they were late in raising rates, but then they were late in cutting. So that's the kind of the tug war right now. Do these trade deals get things back in motion again, that we don't have to worry about shortages or anything like that? Or is this going to just persist on, and then the labor data just breaks and it forces them to do something they really don't want to do, cut more aggressively than the two rate cuts going into 2025?
At the event that we were just at that you spoke at, of course, you had a lot of Q&A and people come up afterwards, and the tariffs are a huge topic because what people want to know is like, what does that look like? And from my perspective, I think it's interesting to think about to pull China out of the mix, because you could have a number of trade deals, but if you don't have a trade deal with China, how much impact does that have? Like the UK, I'm sure we import some great things from the UK, but it's not like that's what we were all worried about.
The thing with China is that the Chinese sell to us a lot more than we sell to them. So Trump sees that as, hey, listen, you need us more. The U.S. is a domestic consumption-based economy, and if Trump really believes that if rates go lower with lower energy prices, they can weather any kind of storm, because he saw that during COVID. So he believes he could win that war with China. But if you really wanted to make this against China, then you would have had all your allies with you. So this is the confusing part about the trade war. Is it the trade deficit? Is it fentanyl? Is it bringing manufacturing jobs back? There's a lot of different facets, but if you're doing trade deals, then the original concept about just putting tariffs on and just letting it stick for decades to come to completely change behavior goes out the door, which is my concept always. I don't believe in a tariff concept, but with China, he really thinks if he can get everybody to join up with them, he'll take that battle.
Interesting. Okay, so you've talked about the fact that the first 4 months of the year belong to one economic cycle, and the rest, starting now in May, belongs to another. When would we see the jobless claims, start to reflect some of the trade war stresses, maybe from maybe from layoffs in the government? Like, when do you think that?
We have never had jobless claims really break up higher unless the total growth of the country slows down and the total consumption. So this is why the U.S. I mean, we have to think about it this light. We've really been in the longest economic and job expansion in history, because we are still consuming goods and services. you need the goods and consumption data starting to slow down noticeably to get claims to have a really strong move out there. Because if you look at federal workers, it's a very tiny smidge. 162 million people working. You're not going to go into a recession because of federal job losses. You could get the unemployment rate higher, but if you really want jobless claims, you need the entire economy, the growth to slow down, consumption to slow down, residential construction workers lose their job, manufacturing. So this is why the next few months are going to be interesting, because here is a high velocity event. And does that bring down the domestic consumption enough to where people are no longer needing to hoard labor, that they feel like they need to cut labor? This is why it's a very unique cycle in a sense. I mean, we really, since 2010, we've not had jobless claims break for any meaningful reason outside of COVID. And COVID was an exogenous shock. That was a global pandemic. So the consumption data has so far held up. The question, can it do it again with credit card delinquencies where they are, where auto loan delinquencies, where the Fed funds rate is, where mortgage rates are? Trump thinks he can win this if they could get rates low enough, and you get the tax cuts in, and you get the energy prices and gas prices to go down. So there is no clear-cut answer until you see growth slow down and consumption slow down.
It's so interesting because, we've talked about this before, that the mortgage market, the mortgage industry has been in a recession since 2022. But the overall economy has just continued to outperform, right? And what would help the mortgage industry is lower rates. You only get lower rates through when the economy is not doing well, or at least some parts of the economy are not doing well. So, and you and I, we never root for like, oh, people should lose their jobs. It's just that we're not going to see lower rates until that happens.
If you get the Fed funds rate 1% lower than what it is right now currently, that 6% mortgage becomes a lot easier to get to. Now the question is, if there was no trade war, there are only 2 rate cuts priced in. Now here we're talking about purchase application data, positive 11% week to week, positive 13% year over year, 14 straight weeks of consecutive. That it's been a while, Sarah, that we have said that. But you also have to be remembering that we're working from historical low levels, and rates fell this year that increased last year. Last year, rates were rising into April, May. This year, it was falling into it. So you don't need much to move the needle here, but getting mortgage rates just down to 6 can do the trick. You already see growth with rates near 7. But to get that next stage to have rates go lower for longer, you need the labor data to break for the Fed to take that next level. Until then, we would have. Honestly, if there was no trade war, the Federal Reserve would have just said, maybe we cut to, we don't know. The labor market is still firm. We might have even had. We probably would have had a little bit more elevated rates currently. If the data has held up as firm as it has. So it's tricky here. It's a tricky battle to how much stimulus do you really need if you get trade deals done? And if trade deals are done and you have a bout of inflation and it takes about a year to get that cleared up, does that actually make it harder to get rates lower in that environment? That's another discussion for another time. But again, the outperformance of the economy is bad for rates when the Fed doesn't have its 2% policy. So this is why the trade war is, everyone's presuming that we're going to have economic weakness and the Fed's going to have to be more aggressive. So trade deals, in a sense, can calm the markets down. But really, if the Fed just wanted to hold pat, it's very difficult to get that next level down lower in rates when we're not at 2%.
So the purchase application data, you said, has been most surprising because you would expect this kind of demand. I mean, it's not like booming, but you would expect this pickup in demand if we had lower rates. But at the rates we currently have, you were surprised to even see this demand, correct?
So like we always said, if mortgage rates range between 6 to 6.64%, the demand grows. The forward-looking data gets better. This is now going into May, and we've had 14 straight weeks of positive. And after 3 weeks of declines, we had a bounce, a double-digit bounce on both the weeklies and the year-over-years. This is just more of a byproduct of in the presentation today. We showed existing home sales going back to 1968. Whenever there's a lull period in sales, when rates fall, that next move is higher because you're working from such a lower base. Well, here's the all-time lowest base of ever. And it's the fourth calendar year of home sales being very low. But even with that, as the 10-year yield has fallen this year, it's given us 14 straight weeks of consecutive growth on a year-over-year basis. It's a little bit different when you count it on a week-to-week, but we didn't have that the last few years. It's actually been a while since we've had a positive growth from January to May. And usually after next week, the first week of May is already in, and that's kind of the seasonality of this data line. Volumes usually always fall after May. So a positive year in that, but I just think if you got down to 6 and you stay there, the buyer pool picks up a little bit more. And then you also get a comfortability. It's like having mortgage rates just go down to 6% for just 2 or 3 weeks doesn't do anybody real good. You need rates to stay lower for a longer duration to get everyone kind of, okay, I can make the move. I can put the house on the market. I'll be comfortable with this. The volatility has always been an issue the last few years in the past.
We've been talking to lenders, and the lending leaders have said, yes, we have seen this pickup. We have seen the purchase apps in our own business. Across several lenders were like, this has actually been a really great period for us. And who would think? Because from all accounts, I mean, a lot of things are in flux. Things are very volatile. Really negative headlines about some things, but yet. But yeah, what did you say in your thing? We were at Universal Studios last night as part of this event. It was really fun. We were in the Jurassic Park section. What did we see? Life finds a way, which I thought was hilarious.
Yeah,
And
like I mean, people listen. If you can afford and you need to move, you do it, right? It's not. I mean, again, but millions and millions of people buy homes every year. We had near 5 million total home sales last year. Same in 2023. We're going to have that again. So if the rate variable comes down just a little bit, the buyer pool picks up. But here, it's just been so long. And every year wages grow, every year households form, every year people get married. Life finds a way to push forward. You can't. It's like I tell people sometimes. Every year that goes by, you get closer to death, right? So if you're holding back for something, what are you gonna do? If you're like in your young 30s, do you wait till you're 45? No. So
right.
people will pull the trigger. It's just this year the 10-year yield fell going into the year where last year it didn't.
From your perspective, is this a heads we win, tails you lose? Like it's a win-win for the mortgage market either way, because either we go into a recession and that's going to cause the rates to fall, or like we lose jobs and that's going to cause rates to fall. I mean, from your perspective, is there anything that could keep rates just where they are right now?
An outperforming economy with inflation elevated is bad for rates. So in that context, that would be a net negative. But we're seeing slight growth on a year-over-year basis with elevated rates. But I always say that as long as home price growth stays very cool, it's a benefit for the future. Because every year your wages grow, every year your household forms. So as long as if home prices were up 8 to 9% this year, I would not be saying it's a healthy year. It's a healthy year that active inventory is growing, but if active inventory is growing and prices were rising 8 to 9%, no, that doesn't do anybody good. So it's the equilibrium of housing that you, after a huge run up in prices, you want prices to cool down. You want wages to catch up. You want households to catch up. And then when rates go lower, you gain that benefit. It's a positive that we're getting that price growth cooling down. It's a positive that inventory is growing. But if the U.S. economy outperforms and inflation is running at 3 to 4%, that can keep rates higher for longer out there. If the growth rate of inflation starts to come back down, I mean, assuming that you get some price inflation already baked into the cake of everyone's model, if you get Fed funds rate to go lower, it's probably because of a bad reason. That's why Fed rate cuts when they don't want to do it is not a good thing for the economy. But in that context, you could get rates lower. And then there's so many people working here and sales are so low. It's just like we show that chart all the time. When you have such a low base, every recession we have seen, home sales tend to grow right after that. So that's just how the economic cycle works for housing, right? Because if the economy is getting weaker, you lower interest rates to stimulate demand. In this context, an outperforming economy with inflation higher is probably not the best thing for rates. But if the economy does get weaker, softer, and the Fed is forced to cut, that's not a positive for the economy, but that can be beneficial just to get down toward that 6%. Again, it's very hard for me to even get under 5.75. If the spreads improve, that's a net positive. But we're in a situation to where we're just working from such low levels. It doesn't take much to move the needle. But if you do get a situation where the Federal Reserve has to stimulate the economy to get growth going, that has always been a benefit for the U.S. housing market. You go back to every recession we've had, even to the 70s, after that lull, you get sales increasing with duration for years, not just some 1 year blip and goes back right down. You get that environment. The question is, can rates stay low enough long enough to get that growth going from a low base? And then after that first initial move higher, we could cross that bridge on what needs to happen next. But when you're working from such extreme lows, you see this in the data. We're having positive year-over-year growth with rates near 7%. We have not seen that in the past few years, but we see it now just because it's been so long that people eventually, millions of jobs have been created, households have been formed, people have to move, people have to buy homes. The Federal Reserve can make that entire ecosystem much more affordable by having rates go lower. And usually when a recession happens, that's their job, is to try to stimulate the economy. That's why home sales look so different after, once you get into recession and then rates go lower, you get that next leg higher.
So many things happening. Thank you for keeping us on top of it all. You watch this 24/7. And so, we'll know when something happens, and we will talk to you again soon. Thank you so much, Logan.
Thank you.